This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. And next to the historic stock market rally we are in the midst of, driven by the exponential technology innovation I'm always talking about, there is no greater economic story of behavior right now than Bitcoin. Last night, the OG of cryptocurrencies made new highs above $12,000 and has been as high as $12,947 on GDAX, one of the popular trading exchanges. More about GDAX coming up. Actually, I need to update this already since I wrote it a few hours ago. Just after 2 p.m. Eastern today, this is Wednesday, December 6th, Bitcoin grabbed another $1,000 milestone above $13,000. And the market cap of Bitcoin is now over $200 billion. And the average daily transaction volume has been over $6 billion each of the past 3 days, including Sunday. So today, Wednesday, December 6th, will probably set a new volume high record, or at least come in second versus the all-time high volume that we saw on November 29th of over $11.5 billion transacted, and that's on all the exchanges. You can find that that aggregate data is collected by coinmarketcap.com, which gives volumes and market caps and that kind of thing, coinmarketcap.com. All right, but what's wild here is even this past Saturday, Bitcoin traded over $5 billion worth, which brings up an interesting dynamic of this new market for an entirely new asset class, Saturday trading. It's crazy, a truly 24/7 market, something I've never seen in my career as a trader or investor. And I think there's some downside to that, Saturday trading. I mean, the whole idea of Bitcoin is decentralized, unregulated, no banks control it. So it's the digital currency for the people, so to speak. So, maybe you should be allowed to trade it on Saturday. But what we're seeing in this sort of trading mania where people are just coming in and getting high off of instant gratification of the price rising is this Saturday trading. And it almost seems like the markets should take a break. Financial markets should take a break on the weekend, let things calm and settle. And so I think that will die down, the idea of, trading on Saturday. Although many traders love it because they get depressed on Friday when the markets close and they can't wait till Sunday night when the futures open and Asia is trading. But we'll see how that works out. All right. So what's really exciting, what's coming for trading though, is what's happening this month. We have two established trading institutions here in Chicago, the Chicago Board Options Exchange, CBOE, and CME Group, launching their own versions of Bitcoin futures as they respond to market demand from institutions, from sophisticated professional trading and investment institutions. They're not catering to the retail crowd, and I'll explain why coming up. And speaking of the retail crowd, as I surf the message boards on Twitter and StockTwits by people who are talking about Bitcoin, trading Bitcoin, learning about it, I see there's a lot of confusion and even fear about what Bitcoin futures will do to Bitcoin. So there's this Bitcoin market that's trading furiously, and people are worried. Is it gonna, is it gonna mean the price is gonna crash because somebody can now finally short Bitcoin, in a meaningful way without owning it? Is there going to be manipulation? And then the whole idea of, hey, this is supposed to be a decentralized, unregulated digital currency. Why would we want to see it go to a centralized, regulated trading venue like a futures exchange? I'll answer that coming up. So, because I've traded futures for many years. For 10 years, I was an FX market maker. And so I've traded over 2 million currency futures contracts in my career as an FX market maker. So I think I have some insights that'll help. So I'm going to jump right in and list 6 things you should know about Bitcoin mania and that you should begin to think about before you trade any Bitcoin or any cryptocurrency product, whether it's on one of these private exchanges or on the futures exchange. And then we'll go deeper into the dynamics and mechanics of the futures contracts being offered by the CBOE and CME group. All right, lesson number 1, bubble in progress. This is definitely a speculative mania. I'm not saying that Bitcoin can't go to $50,000. In fact, my price prediction for 2018 is that it will go to $20,000. I made that prediction a month ago. And so we're on our way to $20,000. But, it's being driven by many forces. It's really a monetary revolution. That's what I'm calling. So beyond it being a speculative bubble or mania, there is this sense that something in the world is changing, that we have a revolutionary technology and a major financial disruptor before us. So this is driving, people opening up accounts. I talked about it would be the biggest topic at Thanksgiving dinner tables, and sure enough, hundreds of thousands of new accounts were opened at some of these exchanges like a Coinbase or a GDAX for people to invest, buy, and or trade Bitcoin. And so the ease of access is so simple too. I opened an account myself at Coinbase, and they didn't ask for, I didn't have to verify any financial information hooked up to my bank account, and I was trading within hours. So the ease of access is also helping fuel the bubble. And then we've got the gurus galore. I mentioned some of them last week in last week's episode, which was titled Bitcoin or CRISPR, which is the bigger disruptor. I talked about some of the people like a John McAfee, the cybersecurity guru, who is a Bitcoin miner, runs a company where that's what they do. They mine Bitcoins and they sell them on the open market. Craig Wright, who some people, I believe, is Satoshi Nakamoto, who wrote the original white paper launching Bitcoin in 2009, and others that I mentioned. These guys, they speak at conferences, they publish, they're on Twitter, and people like me listen to them and follow them because they're the experts. I mean, these guys know the math of Bitcoin. They understand, cryptography, the computer mining of these coins, all that stuff. So, and what the future of finance is, how this is a disruptor, a major disruptor for finance, meaning not that the banks are going away anytime soon, but that banking will change, money will change, and there's always the threat that the central bank or the Treasury decide to crack down, and they don't like what they see. Maybe people are losing money, exchanges getting hacked, that kind of thing. And that they need to come in and do some regulation, and that could impact the price of Bitcoin. So there is major risk exposure, not for the small player, but for large institutions like a Coinbase, any of the exchanges, anybody doing mining that may want to have the risk management tool of futures. So there's risk for a lot of different players. All right, lesson number 2, no charts allowed. And what I mean by that is all the technical traders want to, put their Fibonacci's and their triangle formations and stochastics and moving averages and that. I mean, this thing is just too crazy right now. Maybe it's working, and I don't know if it works for you, fine, but it's not a conventional trading vehicle. It's a new asset class, and it is trading in an extremely bubblicious way, just like the NASDAQ bubble of 1999. So I would say think about that before you try and slap some charting indicators on it. All right, lesson number 3, futures are great. Now, this is one of the topics I'm going to expand on in the second half of today's podcast. I'll explain exactly how futures contracts work and why this innovation will be great for Bitcoin and the entire cryptocurrency space as they offer risk management, leverage, and centralized price discovery to large institutions who need to hedge or trade their exposure to Bitcoin. And I'll dispel many of the worries that people have about the ultimate decentralized and unregulated digital currency being on a centralized regulated trading venue. All right, lesson number 4. Futures are a double-edged sword. This is the other topic I'm going to expand on today, because if you've never traded futures before, a Bitcoin futures contract is probably not the best one to start with. Of all the great things that Bitcoin futures will bring to this new asset class in terms of market structure, liquidity, risk management, price discovery, and stability, it will also be a uniquely volatile product, as you already know if you've been watching Bitcoin trade for even the past month. So since futures use leverage and offer a more efficient use of capital, they are ideal for large hedgers and traders, institutions who can withstand the swings. And it will cost a lot more to trade this product, not in terms of fees necessarily, but in terms of the money you have to put up to be allowed to trade these contracts. So, right now, for the small trader or investor who might buy Bitcoin on one of the private exchanges at $12,000 or even $13,000, they'll probably still hold it if it goes down to $11,000, thinking, hey, I want to see it trade $20,000, so I don't mind if it went $1,000 or $2,000 against me. Well, that's not going to be possible with the futures contract because of the contract size and the leverage. So we'll discuss those specific mechanics coming up. All right, lesson number 5. Coinbase is a friendly introduction. Now, I'm only saying I have no kickback from Coinbase or anything. I have no relationship with them other than the fact that I've tried the platform, and I chose it because it was one of the most standout platforms. I had read about the venture capital firms that helped launch it, like a Greylock Partners is a major investor in Coinbase, based in San Francisco, in the heart of, Silicon Valley tech innovation and insight. And it seemed to me that I'd never heard of that exchange getting hacked and people losing their Bitcoin. So I thought, okay, I'll risk a few $1,000s and try this out. And so far my experience has been good. There are things you need to know, like if you go on there, it takes a certain number of days before, you can lock in your buying price for a Bitcoin, Ethereum, or Litecoin, but it'll take a few days before it gets into your account, and you need to check all that stuff out. So that's how I see Coinbase. It's a friendly introduction. It's a way to dip your toe, or you could call it a good sandlot, to start playing in. And you can also buy a fraction of a Bitcoin. You can buy 0.01 of a Bitcoin if you want. You can buy 1% of a Bitcoin just to get your toe wet. You won't be able to do that with the futures contract because of its size. So, and Coinbase is also kind of fueling the bubble, as we talked about. But the good thing here about playing in the sandlot and getting a friendly introduction is that, in my experience, nothing inspires you to do more due diligence than getting some skin in the game. You risk $1,000 or $10,000, whatever your comfort level is, and then it really ramps up your learning. You're a lot more curious. You're looking up articles on the internet. You're reading, some of the best authorities on this. So, lesson number 6: altcoins and ICOs are risky. Now, this is the area that probably I could do a whole show on, although I'm not an expert on all the altcoins and ICOs. But the point is that there are now hundreds, if not thousands, of these alternative coins out there. And you hear about initial coin offerings, ICOs. This whole area is the Wild West right now. And there are some scams out there. And I even see fancy ads on YouTube for things I don't even understand about people doing innovations on blockchain for, like, it seems like every industry is going to have its own sort of coin to use on a blockchain suited to that industry. So there's a lot to learn there, but if that's your interest, you could spend hours and days just going over that stuff. We're not going to get into that here. I think if you're just, we're just going to talk today about trading Bitcoin and what the futures will offer, and how, even if you never trade Bitcoin futures, which many of you won't because the risk requirements are so high in terms of what the capital you need to put up to trade the contracts, just learning more about how to trade. That's what we're focused on, and help you see where the opportunities are. All right, so next I'm gonna come back, and then we're gonna dive into my next 6 lessons for trading Bitcoin. All right, I'll be back faster than you can spell cryptography. All right, we're back. I said earlier I wanted to address some of the sentiment on social media from StockTwits or Twitter. Traders who are worried about Bitcoin futures. What's it going to do? Hedge funds are going to drive down the price. And some of the other complaints are, I read one today, I hate that banks are getting involved. I thought the whole point was for them to F off. Pardon the language, but this is the idea. They think, there's something wrong now that banks will be in trading Bitcoin futures. But I'm going to help you understand that that's completely wrong, because when you create a new asset class and you want investors to be engaged, they also need a risk management tool, and that's what futures will provide. Another comment I heard is, hey, the futures don't own anything. It's just speculation. Well, this is what futures do. When futures contracts are created on top as a derivative of an asset class, whether it's commodities, wheat, corn, gold, live cattle, that kind of thing, or interest rates or stock indexes, it's a risk management derivative. And it makes the markets more efficient, more stable, because it's basically like grease in the financial gears. Before I forget, I want to share a great tweet I found from Ron Paul on last night. So Ron Paul, senator, he posted a little quiz, and this is it. I'll read it. A wealthy person wants to give you $10,000. You get to choose in which form you'll take the gift. But there's a catch. You must keep the gift in the form that you choose, and you can't touch it for 10 years. And here are your choices. In which form would you like to take the gift? Federal Reserve notes, meaning, U.S. dollar currency, gold, Bitcoin, or a 10-year Treasury bond. Now, I don't know if this quiz is still active, but it's overwhelmingly in favor of Bitcoin. And I actually chose Bitcoin too. So I think there's 70,000 votes in. And this might already be done. I should update it. I'm looking at my tweet from last night. So in this quiz may have closed, this survey may have closed last night, but I see 70,000 votes. 54% are for Bitcoin, 36% are for gold, 2% for Federal Reserve notes, the dollar, and 8% for Treasury bonds. Now I'll tell you why I picked Bitcoin, because just looking at those choices, a wealthy person is giving me $10,000 that I didn't have. Now, do I really need that to live my life? No. How would I invest it? Well, that chunk of free money, I think I would invest it in Bitcoin, because the upside is so fantastic, 10 years from now. And I know what I'm going to get being in the dollar. I have a pretty good idea what I'm going to get being in gold. And I know exactly what I'm going to get being in 10-year treasuries. So let's see if this... I'll see if I can get an update on this from him. Yeah, it looks like it's closed at 70,000 votes, but overwhelmingly for Bitcoin. So that was kind of cool. All right, so let's talk futures. What are futures? I've kind of hinted at this. So this would be lesson number 7. Futures are all about an economic need, okay? That somebody is dealing with an asset class, whether it's real estate, stocks, bonds, gold, or cash. There's, those are the traditional 5 asset classes, right? Real estate, stocks, bonds, gold, and cash. Those are your traditional 5 asset classes. And somebody has some sort of economic exposure that they want to control the risk of. That's what futures are all about. To give you a classic example, let's say you are a wheat farmer, all right? And at harvest, you want to be able to sell your wheat at a certain price. Well, what if you could lock in your selling price? What if you thought that in April, you had this idea that, oh my gosh, there's going to be a bumper crop this summer, and every other wheat farmer is going to be selling on the market, in the autumn at the same time I am, and there's just going to be too much supply, and it's going to drive prices down. Well, in April, that wheat farmer could sell a futures contract, locking in a selling price if he liked where the futures were trading, if he liked that price. And it tends to be in some of these physical commodities that the future price will be higher just because of the risk of time, interest rates, other considerations. But it can get a little tricky too with physical commodities, especially agricultural ones. But basic idea is a farmer could lock in his selling price today for something that he may not be able to deliver for 6 months. So he could sell say a September or November futures contract, guaranteeing what price he would sell his wheat at per bushel, and the buyer of that futures contract would have locked in their buying price, and the buyer might be a General Mills, needs to buy wheat to make all their cookies and cereals and all that, right? So that's the basic idea of a futures contract, is the hedging economic exposure by transferring risk from one party to another. All right, so that's lesson number 7. Lesson number 8 is in that risk transfer, when you bring a lot of people together in a centralized trading venue, which is what the Chicago exchanges did. I mean, it was in the 1860s, right before and after the Civil War here, that the Chicago Board of Trade started trading grain futures because to handle this problem, farmers bringing wagonfuls of grain into the city and all at the same time and having no idea what price they were going to get. And if there was a bumper crop, they might get destroyed on what they were able to sell for. And there are stories about grain getting dumped in the streets and in the river because there was too much supply. And those farmers were devastated, right? They'd worked, all year to provide for their families. So that's when futures contracts started trading, to trade the future value so somebody could lock in a price. So that risk transfer, when you bring all those people together, both the farmer and the miller who needs to buy wheat, that creates what we call price discovery. Let's bring everybody together. What's their interest? Who wants to buy? Who wants to sell? Who's got supply? Who doesn't? And what all those players coming together does is create price. Through buying and selling, through real economic interest. And speculators come in too. Speculators are not the barking dogs on the perimeter of this this fight, so to speak. It's they're also taking the risk away from people who don't want risk, like a farmer, or if we were talking about petroleum, Exxon is involved in both ends of this, buying and selling crude oil and its derivatives. So there's tons of players there, when you think about it, the derivatives markets, the futures and options, they bring stability and market structure to a volatile commodity. So when there's volatility in commodity markets because of weather or other seasonal factors or war, the futures markets absorb that volatility and they transfer risk from those who don't want it to those who are willing to take the risk. All right, that's the number 8 was price discovery. So number 9, arbitrage. Now this is where things get fancy, because you also, in as sophisticated as financial markets are, what also arises is institutions who just want to trade price differences in different locations. So, a simple example might be trading the price of Brent crude, which trades in Europe, versus West Texas Intermediate crude, which trades here in the States. That is the benchmark contract at CME Group. Those prices tend to be different for their own reasons, but there's also an idea of a spread in there. And then there can be arbitrage between physical cash markets and futures markets. Well, this is what's going to happen to Bitcoin, is that once you bring in all these players and institutions who have an interest, either they own Bitcoin or they're mining Bitcoin, or they're a bank who's conducting an intermediate loan for somebody involved in Bitcoin. There's lots of different players, and they all have a little bit of risk exposure to Bitcoin. Whether or not they want the price to go up or down, they've got economic exposure. And you bring these players together, sooner or later, somebody figures out where the future should be priced in terms of, if they launch the futures contract and there's going to be a January contract. So this Sunday coming up, the CBOE is going to be the first Bitcoin futures contract. It's going to start trading at 5 p.m. Chicago time, I think. And the contract value is 1 coin. Now, that first week of trading is going to be exciting because it'll be interesting to see what market makers come in and how wide of a price they show, because we're going to get to see it electronically. There's going to be something to watch on Sunday night. And these players have already been coming up with some kind of model, like where do I price the futures? Now, if interest rates were really high, most futures contracts would trade above the spot price. So, for instance, Sunday night futures contract launches. There's going to be a January contract, a February contract, and a March contract. They're going to launch 3 serial months. Well, my guess is that, I really don't, honestly, I don't know. I haven't seen a model. That's one thing. I have not seen an actual model from a trading firm about how they're going to price this spread between the futures and the spot, the cash market. But one thing's probably for sure is that since interest rates are pretty negligible here, they're not going to be a big factor in, because interest rates are the cost of money, right? And it's opportunity cost. So if you buy an asset, you're out what you could earn at the bank. But since that's such a small factor now, it won't be that built in to the forward price. But it's possible that the farther out months will trade higher. So the February contract might trade $10 or $100 higher than the January contracts, that kind of thing. So this is what, as I've said, watching Bitcoin unfold here, and not just the price, but the whole idea of this new asset class. I mean, we're standing on the edge of history, and that's why I asked last week, which is the bigger disruptor, CRISPR biotech or what's going on in Bitcoin finance? But we're watching this unfold, and so next week is going to be incredibly exciting to see how this first futures contract trades, what institutions are coming in there and making prices, and then what the volume is. All right, so there was 7, 8, 9. Number 10. The function of the clearinghouse. Now, this is what makes centralized futures exchanges like CME Group and now Chicago Board Options Exchange, CBOE, has gotten into futures in the past few years. It's what makes these things work. If you have a central clearinghouse that acts as the buyer to every seller and the seller to every buyer. That's the old lingo, the way we used to say it. Because what the clearinghouse does is they guarantee the performance on anybody's position. And the way that they do that is they make everybody set aside some money. They used to call it margin, futures margin, but then the CME Group a couple decades ago started calling it performance bond. And if you think of performance bond, it's a bond on your performance, right? It's like a security deposit when you rent an apartment. Somebody holds that money and makes sure that you're going to perform on your obligation. So if you buy a Bitcoin futures contract and the price goes against you, you're going to have to pay that difference. So that's the beauty of the clearinghouse. And the exchange itself doesn't hold that security deposit. They make the brokers do it. And the brokers in futures are called FCMs, Futures Commission Merchants. And they are obligated, given the responsibility by the exchange, to have money set aside for every trading position out there. Because what the exchange settles everybody and will make sure, if a trader loses money, that FCM is responsible. So this is a way that nobody loses money in the futures markets without, because of fraud or any kind of maldeeds. It's everybody is accountable for their position. So whether you're long or short, you pay the difference at the end of the day. And so this is one of the backbones of the futures exchanges in Chicago. And so that aspect of centralization actually works to everyone's benefit. And so, there's no Bitcoins being held. Nobody has to have a Bitcoin. They're just trading on the future price, and then they're obligated to be settled against wherever the price is. So, for instance, let's say you buy a Bitcoin at $13,000 in the futures market, and it goes down to $12,000. Well, you've lost $1,000, but before that, the exchange and the FCM want to make sure, do you have enough money in reserve to cover that loss? And if you start running low on your reserve to cover that, you could have that position liquidated, sold for you, exit the position. And that's the way these markets have to work. And that's the way it prevents any systemic risk from occurring. For a long time, the exchanges could always say, hey, no counterparty has ever lost due to the failure of another counterparty, because the exchange stands in the middle and makes sure that the money moves where it's supposed to. All right, And I touched on number 11 here, cash settlement. Again, no Bitcoins are changing hands. You're just settled against the price. So, and now let's get into number 12. The 12th lesson here is contract specs. Now, every time a futures contract is launched, it has specifications. In the case of the CBOE contract, it's going to be 1 Bitcoin, and the minimum price fluctuation is going to be $10. So, yeah, that's what in the futures we call it a tick, but think minimum price fluctuation. So every $10 will be a $10 move on 1 Bitcoin in the CBOE contract. Let me see if there's anything else good I should mention. Oh, the CBOE Bitcoin futures contract, the symbol is XBT. And they're gonna have quarterly expirations, March, June, September, and December, but they're just going to start, and they're also going to have weekly contracts, but they're just going to start out with the 3 near-term serial months. So I think it'll be January, February, and March. And here's what's unique about the CBOE contract. They're going to use the Gemini exchange, which is the Winklevoss twins started the Gemini exchange, and they have a daily auction to determine the settlement price for Bitcoin. And the CBOE has obviously researched that, found it to be credible, reliable, robust way of settling prices, and is working with the Gemini exchange to use that number. So wherever you buy or sell a Bitcoin, you are going to be mark to market against that Gemini auction settlement price in US dollars. And again, nobody has to hold a Bitcoin to make that happen. And I don't know that much about the Bitcoin auction price, or the Gemini auction price, but they obviously have researched it and believe in it. All right. So, this is another interesting note from the CBOE. I'll just read this. Following the launch of Bitcoin futures, CBOE Global Markets Incorporated may explore additional cryptocurrency product opportunities such as ETFs and cryptocurrency options. So, if this works, if this initial product works, which is I think it's going to, you're going to see a lot more products come on the market. All right, so let's talk about the contract size at CME Group. CME Group is going to launch their futures contract, I believe, on December 18th. And their contract is going to be 5 coins, 5 Bitcoins. Okay? So much larger size contract. And this is, where we'll start to see how this is built for institutions. And the minimum price fluctuation, I believe, is going to be $5, meaning every $5 in Bitcoin is where you'll be able to get in or out, so on the 5s. So at, 13,000, and then just below that, 12,995, just above that, 13,005. So every $5, but you're holding 5 contracts, so that would make that $5 move worth $25. So that's where the leverage comes in. And so let's talk about what would be this security deposit, this performance bond that you'd have to put up. Well, I estimated last month that I thought because of the volatility where you're seeing daily moves of 5 to 10%, which translate into annualized volatility of 80 to 125%. Those kinds of daily moves, that's what determines how much the performance bond is. So that's why I estimated it would be 25% of the contract value. So let's do the math here. 5 coins times $13,000 would make a contract value of $65,000. Now, 25% of that's over $15,000. But 25%, I actually think it's going to be higher. And because the volatility has been higher in the past month, I asked a fellow trader what he thought, and he's hearing that it could be as high as a 35% performance bond. So 5 times 13 is 65,000 times 35% would be $23,000. That's what you'd have to put up as your performance bond just to be able to trade 1 Bitcoin futures contract at CME Group. Obviously, at CBOE it would be smaller because it's only trading 1 Bitcoin. But now the FCMs, the futures commission merchants, your broker, whether it's there's just a ton of brokers out there. I think I used Options Express years ago. Charles Schwab owns them now, so they have a futures broker, FCM, for that. I mean, they can make the margin even higher. They can ask for more money because of this volatility. There could be firms that say, you know what, we're not letting any retail customers trade Bitcoin unless they have $100,000 in their account and can, put up 40 or 50,000 for each contract they trade. I'm not saying that's going to happen, but it is up to the individual broker how much they ask you to put up for the right to trade. So this is why this is really an institutional product from the CME, and maybe you'll get some successful smaller futures traders who want to dabble in the CBOE contract. Now, here's the thing I want to cover though about how futures are a double-edged sword, and why I said if you've never traded a futures contract, then Bitcoin futures are probably not the first one you want to try. Because of the leverage and because of this, things move faster, right? When there's leverage on the line, prices tend to move faster. I mean, you can make a lot of money quickly, but you can also lose a substantial amount. When I say a lot, I should just characterize. I mean, with these volatility swings that Bitcoin is having, you're talking about on a leveraged product, swings of thousands of dollars, even in an hour. So, what? This is what futures traders have to learn. And I used to teach this because you have to understand randomness and be able to deal with randomness and then know when you get out of a position that's going against you. The golden rule in futures trading or in any kind of leverage trading is cut your losses short and let your winners run. The problem is, as we've talked about here, is that is not an innate behavior for humans. We tend to hold losing positions, hoping they come back, and we tend to take quick profits. And that is the recipe for busting your trading account. So again, the golden rule is cut your losses short, let your winners run, but people don't naturally do that. You have to teach yourself to do that, and you do that by understanding probability, risk, and how to manage profit so that your average winning trade is 2 or 3 or 4 times bigger than your average losing trade because you take those losses quickly when something doesn't work out. So you're always setting up a risk-reward parameters around every trade. Like I like it here, I'm going to buy it here or sell it here, I'm willing to risk this much, and then you decide in advance, I'm cutting the loss here. I learned from a trader over 25 years ago. He taught me this one thing. He said, you always make your second trade first. And what he meant is you always know where you're wrong, where you're taking the loss, and where you're taking the profit. But you know that you have that exit in mind before you even enter the trade. And that's what that means. You always make your second trade first. All right. So, and people who learn this, how does Vegas work? Vegas works with all that risk and randomness going on because they define the edge. They know what they're going to charge you for a bet, like roulette, and what your odds really are. And really, the reason roulette works in the favor of the house is because there's, 2 slots you can't win on, right? So they're offering you odds on 36 slots, but there's actually 38. And with that little bit of edge that they have, they come out ahead and make, and take 5% from every dollar that gets bet on average. So this is why smart traders learn to be the house and take small losses and let winners run. So, and the other thing that any trader coming into this has to think about is, are they investing or are they trading? The people right now who are buying Bitcoin in this whole mania, they want to see it go up. And only the real skilled traders are getting in and out. This is something you always have to know when you come into one of these markets. I think the distinction between trading and investing is super critical when you're dealing with something that is so volatile like Bitcoin and has leverage and could be considered a bubble. So, all right, let me see. I know I had a couple other things to cover here. Oh, I just wrote this down. No wallet required. When you own these cryptocurrencies, you got to have a wallet. Well, obviously, no wallet is required for trading the futures because there's no physical Bitcoins changing hands, and you're just trading the future price, and you're going to get settled every day. You're going to have to pay your losses, or you get your gains every day on an open position until that expiration. Obviously you can get out anytime, but this is the beauty of futures, and why offering this extra liquidity, price discovery, risk transfer to institutions will actually make Bitcoin better. It's, you think about if it truly is a new asset class, then it only benefits from having risk management derivatives like futures laid over the top. So anybody who's worried about hey, why are we taking the decentralized, unregulated digital gold and putting it on a centralized exchange? It's still Satoshi-like, I could say, in terms of its dream of freedom, right? Just because it has this derivative risk management vehicle off to the side doesn't change Bitcoin. The futures aren't going to be bigger than Bitcoin. When you look at some of these daily volumes, they're not. I don't think the futures are going to exceed them, and that's the whole idea of futures, that they should never exceed the underlying economic asset. And then in terms of regulation, hey, it's security for everybody, and that's what these clearinghouses do. They make it safer for an institution or an individual speculator to come in and be able to trade. All right, I think I covered all the good stuff here. Yeah, I did. Oh, one more thing. I always talk about stocks that are involved in these markets, and there's not really any. I'm not looking at any small companies that have just got into the Bitcoin business or anything like that. I'm looking at established companies that could benefit, that are benefiting, like NVIDIA. NVIDIA is selling more of its parallel processors to the Bitcoin miners that need these things. Amazon is going to be in the space. I mean, they didn't go out and buy 3 domain names around cryptocurrencies just for the heck of it. They're going to do something. It'll be exciting to see what they do. IBM, Google, Microsoft. These are the companies that are going to find a way to benefit from blockchain and Bitcoin, and maybe even Square and Overstock.com. So those are some companies. Of those I mentioned, I own NVIDIA, AMD. I don't own either of exchanges right now, but I'm looking at CME on a pullback. Square has come down nicely, even though it's got a super high valuation. Man, if this NASDAQ correction takes us down to the 50-day moving average in the NASDAQ 100 and Square comes down to the low 30s, I'd definitely look at it there. Already own NVIDIA. All right. I think I covered everything. So, get your popcorn ready for Sunday night when these futures launch. I think it's going to be exciting. And then a week later, the CME launches theirs. It's really going to be a great thing for the newest asset class that we are standing on the edge of history watching. All right, I'll talk to you soon.